the horizon due to a combination of the increasing number of COVID-19 cases in Nigeria and weak economic conditions. Thus, it advises investors to seek trading opportunities in only fundamentally justified stocks. That's a word to all the investors. On to the fixed income and money market for last week. It was a busy one. The overnight rates contracted by 10 basis points week to date to 2.0 in the system afloat. In the absence of any significant inflows, Quadros says, the system this week, they expect the overnight rates to expand. The Treasury bill space, there was trading in the Treasury bills secondary markets, which showed it was bullish for last week on the back of the still buoyant system liquidity. Thus, the average yield at OMO segment contracted by 1 basis points to 1.7% at the NTB segment, as market participants shifted focus to this week's primary market auction. At the PMA, the Central Bank of Nigeria offered to investors maturing bills worth 265.95 billion naira. The auction closed with the CBN rolling over 49.4 billion naira of the 91-day and the 54.59 billion naira of the 108 stop rates of 1.2%, which was previously 1.3%, 1.5%, which was previously 3.4%, which was previously 3.35%. For this week, the tight liquidity, according to Quadros, expected in the system should cause reduced demand for instruments in the space. Let's go on to the bonds, as healthy liquidity in the system sustained local participation and as investors reinvested their coupon payments. Consequently, average yield contracted by 20 basis points to 7.1% across the curve. Demanded the March 2024, while they expanded at the long, which was plus 6 basis points end, following sell-off of the July 2034 plus 31 basis points bond. Quadros expects investors to continue to cherry-pick attractive yields, notwithstanding the extended strain in the system. For the foreign exchange space, the Central Bank of Nigeria $9.86 million week on week against the US dollar by minus $1 billion. That's 389 naira 25 kobo to a dollar at the I&E window, but weakened by 0.7% to 475 naira to a dollar at the power market. In the forwards market, the naira appreciated against the US dollar across the 1 month of plus 0.4% to 393 naira 45 kobo to a dollar. 6 months showed plus 0.4% to 398 naira 7 kobo to a dollar, and the 1 year period of plus 1.5% to 412 naira to a dollar contracts. Quadros says that despite the CBN's stronger commitments towards exchange rates unification, they still see legroom for currency to depreciate further, at least towards for the year is valued currently at 10,466,000,000 and 8,004.42 shares. In terms of top traded securities by volume, the week closed with Central Securities Clearing System PLC CSCS ranking top among 5 most traded securities by volume, and UBN Properties PLC as the 5th most traded stock by volume in the previous week. In the same pattern, volume traded during the week was 1,952,219 units compared to 99,970 units in the previous week, leading to a 1,852,080 increase in traded value compared to week 30. Total volume traded for the year is 7,817,969,286 units. The top traded securities by values are showing the week that Freshland Campina Wamco, Nigeria PLC, topped the top 5 most traded securities by value, and the UBN Properties PLC stood at the 5th most traded security by value for the week. In terms of those that advanced in terms of the market activity for the week, one of NSE OTC stocks closed the week with a positive movement in the price. Freshland Campina Wamco, Nigeria PLC, which currently holds a market capitalization of 120.35 billion naira, closed the week at 123.27, representing a 1.75% increase from the previous close of 121 naira 15 kobo. Who were the decliners for the week? Two of NSE OTC stocks closed the week with negative movement in prices. And that's Afriland Properties PLC, which has a current capitalization of 2.72 billion naira. It closed the week at 1 naira 98 kobo, representing a minus 10% decrease in terms of its price from 2 naira 2 kobo. Niger Delta Exploration and Production PLC, which currently holds a market capitalization of 49.67 billion naira, closed the week at 273.82 naira, representing a minus 10.71% decrease from the previous close of 306 naira 65 kobo. That's the updates from the NSD, how market performed, and we'll continue to bring those updates in the new week of previous week performances in the market. Let's go into Nigeria Stock Exchange, which has proposed rules on outsourcing of functions and shared services alongside fintech collaborations. This will be of huge interest to market players and those in the tech space. The Nigeria Stock Exchange is proposing following new rules as additions to the rule book of the exchange dealing members rule. First part of it is proposing rules on outsourcing of functions and shared services. Second part is proposing rules for the broker for fintech collaborations. And here's a summary of the proposed rules. The proposed rules on outsourcing of functions and shared services captures the following. The exchange has observed that a number of dealing members engage the service of third parties, professional service firms to perform some activities and functions related to their business operations and regulatory responsibilities. However, it is noted that these outsourced roles and functions are not adequately performed and monitored within the operations of the dealing members. The exchange recognizes that dealing members and related entities share certain services within corporate group structures and sometimes outsource functions for strategic reasons and to reduce operational costs. This makes it imperative to provide appropriate guidance in order to ensure that the integrity of the market is maintained and to mitigate the risk of dealing members operating with or through third parties who are not regulated by the exchange or any other recognized regulator. These proposed rules seek to achieve the following: clarify the functions or roles which dealing members are required to manage internally and roles which dealing members may outsource to third parties or share within a group structure. Standardize and stipulate parameters of the processes, procedures, and documentation of outsourcing or service sharing by dealing members, and balance dealing clients and other risks associated with outsourcing of functions and shared services. In the area of proposed rules for broker to fintech collaborations, the exchange notices that recent trends indicate that many traditional financial service providers are reviewing their existing business models by incorporating new technologies to enhance how they interact with clients, provide financial services, and monitor regulatory compliance. The exchange has observed that some dealing members' firms have entered into collaborations with financial technology companies, commonly known as fintechs, to provide digital applications as a platform to attract domestic and foreign investors to trade securities in the Nigerian capital markets. Therefore, the proposed rules for broker to fintech collaborations prescribe the steps and parameters for dealing members' firms who are desirous of engaging in broker to fintech collaborations. The rules also propose to empower the exchange to regulate such dealing member and fintech relationships in line with the exchange's objective to protect investors from any adverse effects that these relationships may have. This is without prejudice to the potential benefits of making the market more attractive to investors through the broker to fintech collaborations. The proposed rules will provide numerous benefits, which include the following: setting the requirements for dealing members that wish to enter into such collaborations, regulating the products and services being offered to clients under the collaborations, and prescribing mandatory requirements aimed at minimizing the risk associated with fintech collaborations. The NSE is also making invitations for comments from the public and investors. The exchange says it's pleased to invite all the public and investment community to participate in its rulemaking process. According to the NSE, your participation is required by way of reviewing the proposed rules and providing comments thereon. A set of the proposed rules may be viewed through the link provided by the exchange. The exchange views the participation of the investment public as very important for the following reasons: to create public awareness and solicit the public's feedback on the proposed rules amendments and to improve the quality of the proposed rule amendments and thereby have a robust, well-written set of rules. So NSC is involving as many stakeholders as possible in this commentary process in order to achieve the aforementioned goals. It's assuring the public that it will be considering all applications and feedbacks in the final text of its rules. Looking at the response and the timeline, the agency is going to be grateful if these comments come on or before the 3rd of August today. So before the close of business today, you are encouraged to send your Word document attached to an electronic mail to Mr. Oluwatoyin Adenugba. He is the head of rules and interpretation at the exchange. So please take note of the email address oadenugba@nsc.com.ng. oadenugba@nsc.com.ng. You can send a mail from your email address with an attached Word document on your views about these proposed rules to that email address to get your input into the process. The NSC has also notified the investing public that the draft rules are subject to the approval of the National Council of the Nigeria Stock Exchange and the Securities and Exchange Commission. Impressive to hear that there are provisions now to see collaborations between the brokerage firms, the stockbroking firms, and fintechs, and also in terms of functions and shared services. Very important to embrace innovation in this period. And we hope to engage stakeholders in the market on these rules and also officials of the Nigeria Stock Exchange in the course of our program. For the commodities market, it is showing that agriculture continues to come to the fore and will continue to be a major thrust of Nigeria's drive to diversify its revenue from crude oil dependency. And one area we're seeing is the recent launch by the federal government of the Agriculture for Food and Jobs Plan, the AFJP, at an event attended by various stakeholders last month in Funtua, Katsina. FX were one of the key stakeholders involved in that process. I know FX is a private commodity exchange in Nigeria. The program, which is intended to roll out a structured plan to combat food insecurity in Nigeria, has been partly exacerbated by the incidence of the COVID-19 pandemic, and the measures introduced to stem its spread targets 2 million smallholder farmers spread across 36 states of Nigeria and the FCT. 2 million smallholder farmers. Food security, it says, is a vital agenda on the national and global scale, and COVID-19 has presented unusual shocks to food systems that require adequate planning and response to ensure resilience and recovery. The AFJP aims to produce 10 million metric tons of food, including carbohydrates, animal protein, and edible oils within 12 months. The program will be operationalized through a collaboration of the federal government with various state governments, the Central Bank of Nigeria, the Federal Ministry of Agriculture and Rural Development, and various private sector agri-service providers. This is a new initiative that is designed to improve the process. According to the CEO of AFX Community Exchange, Mr. Yodeji Balogun, who was present at the launch of the event, he said the realities of the pandemic is testing the food systems. It is up to all players in the agricultural value chain to intervene in ways that are both sustainable and impactful. The Agriculture for Food Jobs Plan provides structured production support by giving zero-interest input financing option to farmers, enabling them to access fertilizers and seeds for their production activities, which will result in increased yield at harvest time. The program will reach 2.4 million farmers, producing over 10 million metric tons and providing food for 100 million households. For the last 5 years, FX has worked in a consortium with the Alliance for Green Revolution in Africa, AGRA, and other public and private sector partners, including National Agricultural Extension and Research Liaison Office Services, NILS, and Sasakawa, to build operational capacity to deliver improved financial inclusion, farmer training, and access to finance and markets. The programs run under this framework and have improved the capacity of farmers across the country, enabling year-on-year growth in yields and productivity that can be doubled down on in executing the AFJP program. FX will be contributing 750,000 farmers to the AFJP program through this consortium of partners that include AGRA, NILS, and Sasakawa. AFJP program will allow private players like FX with access to a large number of farmers to collaborate and work together, sharing knowledge and technology to drive the end goal of food security in the face of COVID-19 pandemic. The private sector is also being incorporated in the program as off-takers for the produce, which will ensure that farmers can access a market at the harvest time. The coordinated efforts of the FJP program will ensure linkages for farmers with quality inputs and support through the production cycle and access to market at harvest. This will benefit the country's drive to be food secure and create and protect jobs in the sector. Commendable effort in agriculture, and we hope that this will be sustainable and achieve its goal. 2 million farmers to benefit from the AFJP and is designed to feed 10 million households. Well, we hope that this works well and creates value in the agri-sector. Let's go global, and globally, investors are preparing their portfolios for a potentially rocky patch. Yes, potentially rocky patch in the US stocks. Why? Because they're worried that a dramatic rebound in equities may stall amid dimming economic data and rising political uncertainty. Those two things, dimming economic data and rising political uncertainties. Most money managers are wary of cutting equity exposures too drastically in a market that has rallied more than 40% since late March and stands near all-time highs despite widespread economic devastation and a global impact of the pandemic, the coronavirus pandemic that we all know. Also, the market is still looking at possibilities of the divergence between stocks and the real economy and is worrying a lot of investors. The US growth took its worst hit on the record of the second quarter, while more recent data points to fading consumer confidence and jobless claims back on the rise. The S&P 500 meanwhile stands at 4% below all-time highs, though its weekly advances have grown progressively smaller in July. That was last month. That disconnect is pushing some investors to beef up cash positions or tilt their portfolios towards Europe, where economic prospects appear to be brighter than the United States of America. The performance of option strategies designed to profit in sideways markets, such as the Iron Condor, which involves long and short positions on both calls and puts, have also improved. The Iron Condor strategy, from the perspective, has drawn controversy and prompted investigation by some legal firms following its poor performance during the sharp sell-offs, such as we saw in December 2018. The concerns over the US presidential election, yes, the very big one, are also mounting. And that's why since Thursday, when President Donald Trump suggested on Twitter that the November 3rd presidential election be delayed, though he has no direct authority to do so. Net outflows from equity funds were $1.8 billion in the fourth week of July, while bond funds took in $17.2 billion and money market funds received $5.5 billion in the global and US markets. That's the EPFR. You know much about Argentina. Argentina is a country that has had so many issues when it comes to default in debt and economic instability. And here again, we're hearing from Argentina. A group of Argentina's creditors has contacted the Institute of International Finance and other global bodies for support to amend legal clauses in the sovereign bond restructuring, a spokesman has said. Buenos Aires is trying to clinch a deal to restructure around $65 billion in foreign debt. You heard that, $65 billion. And they're looking towards this week by Tuesday. Though it is likely they will push that deadline back after bondholders group behind a counter proposal, causing an impasse in talks. Specific details of what creditors are seeking the support of the organizations on was unclear, but collective action clauses, CAC, which determine the requirements for any future changes made to the bond agreements, are a key issue in the negotiations. The bondholders, including BlackRock, Ashmore and Fidelity Management and Research, also made informal contact with the International Monetary Fund, US Treasury, and the International Capital Market Association. A creditor source told Reuters about the whole development in Argentina. Those of us that follow, like I said, the Latin American, South American countries, know the history of Argentina and the faults and its challenge in trying to stabilize this period of the COVID-19 has even aggravated the concerns around Argentina's ability to stabilize its economy, to navigate this pandemic, and even service its debt. You heard there's $65 billion worth of debt is a huge size, it's a huge chunk, and it's a country that's defaulted over 3 times. So you know why the Argentine people are really concerned about how stability will help the economy and the markets. The signal is giving also for the MSCI and international market players will come on the fore, and of course, its credit ratings will be another issue, because when this happens, it affects the credit rating of the Latin American nation. As you heard there, in the US, it's political uncertainty and economic stability, the major concern for global stocks, which also is part of the reasons you're seeing a caution and a dovish approach from the US Federal Reserve, the US Central Bank. Well, you've seen that investors are also looking towards Europe. Why? Because European leaders were able to resolve last month the issues around a 750 billion euro sustainability fund, which is required to help stabilize economies in the European region that are going through the COVID-19 debacle. And so with that fund agreed, there are prospects that Europe may begin to stabilize and be able to navigate and weather the storm of the global economic crisis and conundrum that has come as a result of the COVID-19 pandemic and also the dual impact of the global crude oil market or commodities market volatility. Also, the global markets are still bracing for clarity in terms of the vaccines, and we will follow that this month, because the clarity on the progress made in the vaccines from Moderna and its partners, AstraZeneca in Europe and also Gilead in the US, all the measures being taken will be monitored. It is now number 3 in the highest cases of deaths recorded, and that shows you how these whole developments and stories are going to affect investments. The markets respond to signals and informations, and definitely the statements this month by the US Fed on the economy will continue to be monitored. Bank of England, the European Central Bank, those 3 in succession. First, the US Fed, chaired by Mr. Jerome Powell, the Bank of England, headed by Mr. Andrew Bailey, and of course the European Central Bank, headed by Christine Lagarde. Also in Africa, major central bank governors like Mr. Godwin Emefiele of Central Bank of Nigeria, Central Bank of South Africa, Legato of South Africa, all their key statements will be very critical in how markets respond. Emerging markets, frontier markets, and developed markets. That's what will be very key as we move in the month of August. But most importantly, in Nigeria, the Securities and Exchange Commission will play a very key role as markets continue to watch how they will respond in terms of market surveillance, how they engage market stakeholders, as we expect that the long-awaited Capital Market Committee meeting will come on board. Hopefully this month we should be able to chart a pathway for how the market is ready to respond to the pandemic, navigate the pandemic, and build confidence for more investments. As you can see, the equities, there's so much caution as we see much activities in the money market. The debt market is being assessed heavily, even from the corporates looking to raise more funds, and also the entire value chain of the capital market ecosystem. We'll bring all those insights to you as they come with exclusive interviews in the course of the month. So always watch out for our program, 10 a.m. every day, as we give you all these insights. And that will be all for the market review today. You can join us throughout the month and in the week for reports, analysis, and exclusive interviews, like I said earlier. Log on to the website www.proexchange.com to all investors this period. Please be aware of online platforms that promise you 100 to 200% returns that are not registered or regulated by the Securities and Exchange Commission. Do not give in to their schemes and strategies, because they are out to rip up your hard-earned earnings and savings. That will be all for this edition. Thank you for making it today with us. We hope to have you tomorrow. Join us on interesting conversations. Till we come your way again, thank you for watching. Have a lovely day, and please don't forget, stay safe.